If you're actively engaging, creating content, and leveraging social media to help you grow your business, it is one of the highest and best uses of your time, and it only becomes a better use of your time over time as you continue to grow that presence.
Welcome to the Multifamily Wealth Podcast. I'm your host, Axel Ragnarsson, and on this show, I dissect how seasoned multifamily investors started, built, and scaled their businesses.
What's going on, everybody? Welcome back to the quick solo episode here on the Multifamily Wealth Podcast. In this episode, I'm going to be talking about 5 ways that multifamily investing has changed in the last 8 years. And the reason I'm using 8 years is that's as long as I've been in the business, since 2016. And these are also 5 trends that I see continuing to further develop over the next 8 years, over the next 10 years. And these are, when I think about how investing in multifamily has changed, how this whole process has changed, how the landscape has changed in the last 8 years, these are the 5 things that most directly come to mind. And some of this is going to be data-driven. Some of it's going to be more how the actual investing process has just changed and how this game is different than it was 8 years ago. And a lot of these all of these, I should say, in my opinion, are going to be continued trends that we see affecting the next 3, 5, 8, 10 years in the multifamily sector. So the first one that I want to talk about is the fact that there are far fewer unsophisticated sellers and just owners of multifamily real estate in 2024 than there was back in 2016. And I think that's really for one primary reason, and that is there's just too much content, too much educational content available for investors who are looking to learn about multifamily investing. Between all of the podcasts, all of the courses, websites like Bigger Pockets, other blogs, it's just too easy for somebody who owns a rental property to just go online and learn more about multifamily, more about rental property investing, more about underwriting, more about operations, more about financing, etc. The average baseline skill set of a multifamily investor has risen since 2016. And it's just because it's almost impossible to not be absorbing real estate related content if you're in real estate, even if you're someone that isn't that tech savvy, right? It's not like we're talking like apps and tools. It's like it's just website. There's so much content. And that's had a few consequences, or that's affected the market in a few different ways. One, I think that the baseline level of service to the residents are higher. There are just less slumlords than there were back since I got into the business just 8 years ago. Even more so than just 4 years ago, 5 years ago, which is obviously great. It's just a higher level of knowledge as it relates to being a successful operator of rental real estate today than there ever has been. And that will continue till the end of time, right? That's never going to be something that changes. So typical service to the resident is higher, which is great. That also means that the market has become more efficient from a rent standpoint, right? And it's as a result of there being more education out there, there's less unsophisticated, and there's less individuals mispricing their properties. The first two points go hand in hand, though, as it relates to oftentimes bad owners misprice their rentals and they don't have enough cash to maintain their properties, and it's a bit of a hamster wheel of a problem. So those two things oftentimes go hand in hand. The folks that are getting into real estate now are doing so with their eyes much more wide open than they ever have been as well, in terms of buying a property and understanding what needs to be done to operate that reasonably well. So there are fewer people getting into real estate that just don't have any clue what they're doing. And that's especially true for the younger generation, which I'll define as anyone who's 18 to 35 right now. Everyone in that age demographic grew up with technology, grew up with all of the answers that they could need right at their fingertips. And that is, again, only going to continue to permeate itself into the future. So to recap, far fewer unsophisticated sellers and owners than there ever has been. And finding owners that are truly just completely just unsophisticated as it relates to the operation of a property are becoming less and less common. They still exist, but they're less and less common, and they will be less and less common as time passes. Change number 2 that I think is just, again, it's hard not to miss, is that the yields are just so much lower today than they were in 2016, and the market is just so much more efficient today. And again, I think that's a symptom of the fact that there's an abundance of information now, that there's an abundance of data. Tools like CoStar, tools like Zillow, all the local MLS services, all the property management softwares out there that report on data. It's just hard to not have data at your fingertips around where rents are, where cap rates are, where pricing is. And the likelihood that properties are being mispriced is lower. And the likelihood that brokers understand the market in which they're selling property in is much higher. I remember back in 2016, 17, 18, one, obviously, we were just buying properties at per unit prices that when compared to the per unit rental rates were at such a wider gap. In Southern New Hampshire back in 2017 and 18, we were consistently spending $60,000, $70,000 per unit to buy apartments, just speaking broadly, for units that would rent for $1,100, $1,200, $1,300. You were regularly hitting that 1.5%, 16%, 17% rule as it relates to your gross purchase price and then the gross monthly rents. I should say your purchase price and the gross monthly rents. That gap has narrowed considerably over that period of time, right? And again, back then, cap rates 8, 9, 10%, 11%, 12%. You could find deals trading at absurd cap rates because there was just less information. There were fewer just hubs for data that individuals could go to, and again, just a lower level of sophistication. Now deals are trading in a much tighter window. Those same properties that traded for $60,000 a unit back in 2018 are now trading for $150 a unit in 2024. I mean, we've over 2x the pricing of those assets specific to the market that I participate in. And rents have not 2x'd over that same period of time. They've gone up quite a bit. So that $1,200 a month apartment might be $1,600, $1,700, $1,800 now, 50, 60, 70% increases, but it has not nearly kept up with the rate at which the cost to acquire that asset has increased. So the fairway has shrunk quite a bit, and the yields are just fundamentally lower. Deals are trading in a much tighter window from a cap rate standpoint, and you're not seeing as many just total outlier deals where you're hitting those 2% rules, where you're hitting, where you're buying at an 8 cap on actuals with the chance to continue adding value and bring it to a stabilized 10, 11% yield on cost. While they still happen, those deals do occur. They are significantly fewer and farther between. And overall, the market's just become more efficient. And this is also a symptom of more and more individuals getting into real estate as the asset class, again, has become more commonly adopted with everyday individuals, everyday investors. Third change that I've seen that I've just been shocked at the rate at which this change has occurred is the adoption of technology in operations, and specifically within property management. Back in 2016, 17, value add used to be, I'm buying this apartment building and I'm enabling tenants to pay online. Like that was a viable value add strategy. Just adopting property management software and just giving tenants a portal and a place to submit maintenance requests online, collecting rents online. Like that was something that people just did as their value add because there were so many owners that weren't doing that, and just working with a PM that adopted and heavily leveraged a good property management software was like, that was the technology that was being used at that time. Was just, you're using technology to screen tenants to collect rents and to send investor reporting. Cool. Like you're doing a lot. Like that's pretty good. You sprinkle in some basic adoption of some leasing technology. Wow, you're really ahead of the curve. Now, obviously, using a property management software in 2024 is table stakes. Every single investor uses one. If you don't, like, you are so far behind, it's insane. But the table stakes for software that's being used in property management is so much higher now, right? We have services like Tenant Turner that allow you to do remote showings and report on very specific data related to the success of leasing. We have services like Property Mail that's an outsourced maintenance coordinator where tenants call a number and then they have reps that walk tenants through DIY fixes over the phone before dispatching to techs. There's all kinds of AI integrated solutions such as AI leasing assistance, dynamic pricing that's set by AI and algorithmic data. And all of these changes have, one, made property management significantly more effective and streamlined. It's also reduced the manpower required within a property management company. And it's also really increased the efficiency of scattered site management. So for the investors out there that are buying a bunch of deals that aren't large enough to support on-site management, right? They're buying a lot of 10, 20, 40 unit deals, 5 unit deals, whatever it is. It's become much easier to manage those properties, because of the fact that so much more of the property management process is been assisted and aided with technology. And really, I mean, that was 2016, completely different world in that respect. 2020, yeah, you got some folks that are adopting a lot of these ancillary features. Now in 2024, if you're not like using AI in your property management company, you're probably not operating as efficiently as you should be. And the game is just totally different now. Change number 4, and this is somewhat similar to the changes in the property management tech landscape, but it's related to talent, and that is the use of virtual talent, virtual staffing, virtual employees has basically gone from something that was virtually non-existent in 2016 to where in 2024, if you are not leveraging virtual talent in your business, you're being left behind. You are actively being left behind, especially in property management. In property management, half of the jobs in a property management office can be done remotely and therefore can be done out of country by remote team members, by virtual assistants, etc. Anything that does not require physical presence at a property can be done remotely, and it should be done remotely. And there is still a bit of a lag here as it relates to the adoption, but the vast majority of property management enterprises, small businesses in general, at least understand that there is a value in working with virtual talent. The level at which they're adopting, and the speed at which they're adopting may be different, but there's some understanding there. The companies that are ahead of this curve have dove headfirst in the deep end within the virtual talent pool here and have really started to build their businesses and culture around virtual talent. This is something that we're doing in our management company. It allows us to silo positions much more quickly as it relates to dedicating staff members to very specific functions within the business that we otherwise wouldn't have been able to do with US talent because it's much more expensive. Therefore, we're increasing the ownership over different components of the business. We're increasing our headcount and therefore the coverage of our business at a higher rate and a much faster rate. And it's allowing us to scale and grow quickly and more predictably. And that's something that's happening just so quickly. And outside of property management, there's all kinds of use for virtual talent. Just one, if you're a high income earning individual, you should have a virtual assistant helping you both in your personal life and your professional life. We have many folks virtually helping us with asset management at the aligned real estate partners level, which is kind of the investment company level. We have multiple people helping us on the content side. We have folks helping us with underwriting as well, market research, data scraping, acquisitions. We're actively building our business with virtual talent as well at the investing level. And it's something that when we go to hire for a position, my first thought is, can I hire a virtual individual to assist with this? And I really need to convince myself that I can't before I end up going the US route. And this is one of these segments of the overall, this is one of the bigger changes that I'm seeing. Like if you're not actively pursuing and adopting this change in your business, then you are being left behind. The last change that I'm going to talk about, and arguably the largest change that I'm going to discuss here, is the speed at which social media and content creation has completely changed this business. And there's multiple avenues in which it's changed it, right? And I'm going to try and breeze through a handful of these, give you some context as to each. Raising money for your deals, finding and building partnerships, meeting vendors, establishing credibility, finding deals, establishing trust with those that come across you in your business, learning, basically developing new strategies and tactics in your business, gaining exposure to what other investors are doing in your marketplace or in your asset class, using social media and using it effectively and consistently over a long period of time will transform your business, regardless of whether or not you're looking to raise money or sell an info product or do anything, right? When I started creating content for Instagram, I had no plans to sell educational content, to raise money for my deals. The only reason I was doing it was to just meet other investors and to just document what I was doing in my business. And it led to all kinds of different opportunities, meeting partners in other markets that I ended up buying deals with, becoming a little bit more known in my marketplace. And when people, being followed by other investors in my market and other service providers, wholesalers, real estate brokers, mortgage brokers, etc., who ended up bringing me deals and referring me deals. So it helped from a deal sourcing standpoint. It helped me meet GCs and painters and plumbing companies and just other vendors. It just also helped with credibility. When I was offering on deals, if there was a broker who was familiar with my social presence, They could go scroll through and get a sense of my portfolio, get a sense of my experience, get a sense of who I was. That social presence also led to the podcast, right? And the podcast has been the avenue in which I've built trust at scale with a lot of our investors. If you're not actively cultivating a social presence or at least engaging online in some capacity, whether that's Instagram or LinkedIn or in Facebook groups or wherever, you're leaving a lot of growth on the table. And it's funny. I don't like social media from a personal standpoint, right? I try not to spend a lot of time on social media because I don't necessarily think it's time well spent personally. And I think there's better uses of your time. But that being said, from a business standpoint, if you're actively engaging, creating content, and leveraging social media to help you grow your business, it is one of the highest and best uses of your time. And it only becomes a better use of your time over time as you continue to grow that presence. And again, similar to using virtual talent, you should have some level of presence on social because the stakes are becoming too high and you're going to be left behind by a younger generation. Even if you are a young person right now not using it, you have to understand that everyone who's 18, 20, 24, 25 that are finding real estate, that are getting into real estate, that are starting to hustle, they're going to be using social media, and their quick adoption of that, whether regardless of the platform, you're going to have a hard time keeping up with that, long story short. And the one thing that I really want to highlight is the raising money component of this. Obviously, the Jobs Act of 2012, where real estate investors can go out there and syndicate deals and they can go out and crowdfund equity. That's change number one in the modern process of raising capital to fund deals. Whereas it used to be you had to make calls to very wealthy guys who are going to write you checks. Now you can crowdsource equity and raise capital in $25,000, $50,000 chunks in a legally compliant fashion, and you can advertise publicly, assuming you're using a 506c, right, exemption. But it's very important to note that this gets much, much easier when you have some kind of a following. And a lot of the new investors who are trying to build their relationships with investors start with social media. They start by telling their story, by making YouTube videos, by starting a podcast, what have you. And they're starting to try and build trust, build credibility, build a brand awareness of their business. And then when they have deals, they take it to their audience. And that's how they raise money. And that is becoming the roadmap into growing your real estate business for individuals that don't have large investors in their network. And it's leveling the playing field in that respect quite significantly. Obviously, that's how we raise money in our business. It's one of the strategies we use. But everybody I know who's actively started creating content for social media and actively started growing some level of a presence online has never told me that they regretted doing so, regardless of the size of their following. And I think that's a dynamic that I think, again, will continue to permeate its way through the multifamily sector as time passes and as we work into the future here. So to recap the 5, number 1, there are far fewer unsophisticated sellers and owners as a result of there being an abundance of educational content online, more so than ever before. The yields just available in multifamily real estate to investors is lower now than it was 8 years ago, which is obvious. But it's also because of the fact that there's an abundance of data available and there are fewer outlier transactions and more deals are being done within a more narrow window from a pricing standpoint. Number 3, property management tech is advancing at an alarming rate, and the availability of tech to multifamily owners has never been higher and will continue to only increase with artificial intelligence. Number 4, the use of a virtual talent is growing insanely quickly, going from almost being non-existent in 2016 or being a novelty to in 2024 being a core part of most people's businesses that are growing real estate businesses. Number 5, social media has completely leveled and changed the landscape as it relates to raising capital, building partnerships, meeting vendors, establishing credibility, finding deals, etc. If you thought this episode was insightful and if it sparked a change in how you're approaching the growth of your business and where you're going to be spending your time, please consider leaving the podcast a rating and review. If you think somebody might find this episode insightful, please consider sending it to them. Text, email, however you feel like sharing. It's very easy to do so both on Spotify and iTunes. Takes you 30 seconds. Not even. Takes you 5 seconds. Honestly, there's no excuse not to if you think of somebody who might find some value in here. And again, I, of course, appreciate that. It helps the show get in front of more folks and grow. And again, I appreciate you all for listening. And I'll catch you guys on the next episode.